Well, thank you guys very much for joining us. This is our next in our series of webinars. This one is specifically for information for new homeowners. We are going to just kind of touch on some of the basic general information that's important for new homeowners to know about the property tax system. As we go through the webinar, if you have any questions, please use the Q&A box. We may answer some of your questions as we go through the presentation, but if not, we'll circle back at the end and we'll answer as many questions that are in the Q&A box as we can at the end of the presentation. And with that, we will go ahead and get started. So first, we'll talk about the property tax system and who does what. And there are three main players in the property tax system. You have the appraisal district, which is my office. I'm Maria Krigler, and I'm the chief appraiser of Travis Central Appraisal District. Our job at the appraisal district is to determine the market value of properties, and we do that every year. Our assessment date is as of January 1st of each year. And we also send out notices of appraised value. We handle any protests regarding market value, and we administer exemptions and property tax deferral applications. The other player is the taxing units, and those are your city, your school, your county, your emergency service districts, your MUDs. They all play a role as well. They set their budgets, and then they set the tax rates, and that determines the overall tax burden. And then the final player in the property tax system is going to be the tax office. And they actually do and calculate and mail the property tax bills. They do the actual collections of the property tax payment, but then they also handle vehicle registration. They do license plates, voter registration, placards for people with disabilities, alcohol and beverage permits, and handle court costs. So these are the three main players in the property tax system from a governmental perspective and what each of us do. So the property tax calendar, and there's some really important dates that you have to know as a property owner. The first is January 1st, and that's, we call it our assessment date, but that's the date that our values are set. As of January 1st, what was the status of your property on January 1st, and what would it have sold for as of January 1st? Because we're quite trying to determine the market value. So January 1st is a really important date in the property tax calendar. April 1st is another important date. We start sending out our notices of appraised value, and we start doing that in April. Now they'll be sent throughout the month of April, but we actually start that process starting April 1st. May 15th is the general deadline to protest if you want to protest your property value. July 25th is the date that we have to certify the appraisal roll. That is, the chief appraiser will tell the taxing entities exactly what the appraisal roll is, and then the taxing entities are going to use the value that we give them in the certified appraisal roll to set their tax rates. And they do that in August and September. And then in October, they start mailing out, the tax office will start mailing out property tax bills. November is the date for voter approval elections. So there are some provisions that will require taxing units to get voter approval for the tax rates that they want to set. And those elections are always going to be held in November. And then January 31st of the following year is when property tax payments are billed. Anything paid after January 31st of the following year becomes a delinquent tax bill. So you want to make sure that you get your payments in timely and do that before January 31st. So in calculating your property taxes, there are three factors that determine the total amount of taxes that are going to be imposed on your property. First is the appraised value. And that's what's established by the appraisal district, and that's my office. Second is any exemptions. If there are any that you're entitled to, any exemptions would be another key factor in determining your total amount of taxes. And again, exemptions are another item that are administered by the appraisal district. And then third is the tax rates, and those are set by the taxing units in which the property is located. Most property owners are going to be located, everybody will be located in a county. You'll also be located in a school district. You may also be located in a city or a MUD or a healthcare district, community college. So there are a multitude of taxing entities that levy a tax against your property. Each of them are going to be listed separately, but each one of those will set a tax rate, and each one gets to set their own tax rate based on the budget that they develop. The purpose of the appraisal is not to determine what your total tax burden is going to be, but to allocate that tax burden fairly amongst all taxpayers based on the relative value of their individual properties. It's important when we talk about appraisal and the work that the appraisal district does that you know that there are 3 different types of values that are determined by the appraisal district. First is the market value, and that's based on what would your property sell for as of January 1st. Market value, again, is just reflective of what we have seen already happening in the current market. So if you look and see what kind of sales have happened in the last year in your neighborhood, that will give you a good idea of what the market value of your property would be for, because that's what we're going to look at. We're going to look at what have other similar properties sold for to make our determination as of January 1st, an estimate of what would your property sell for. So the first is market value. And again, that's strictly based on what's happening in the market. There's no limit on that. It is exactly what the market says it's going to be. The second value is the assessed value. And this is a reduced value if you've got a homestead exemption. It is a reduced value. So the homestead exemption provides many benefits, but one of those benefits is a limitation on how much the assessed value can increase. Now, the assessed value is a calculation. It is last year's assessed value plus 10% or the current market value, whichever is lower. So assessed value will always be just a calculation. And again, that's last year's assessed value or the current market, last year's assessed value plus 10%. Or the current market value, whichever is lower. In our Austin market, it has been so robust and so vital for so many years that it is very, very rare for the current market value to be less than the assessed value. So most property owners that have a homestead exemption will see that they've got an assessed value, and that assessed value will be somewhat less than their current market value. The final value determined by the appraisal district is going to be your taxable value. And that's going to be your assessed value minus any exemption amounts that you're entitled to. And that becomes your taxable value. That is the value used to calculate how much you pay in property taxes to each taxing entity. Now, the amount of exemptions that you're entitled to will vary from each taxing entity because, again, each taxing entity gets to determine how much of an exemption that they're going to grant. And we'll talk about exemptions a little bit later. For the appraisal district in determining market values, we are required by the Constitution and state law to appraise properties at 100% of market value. That is, what would they sell for? And again, our assessment date is January 1st. So we're looking for what would the property sell for on January 1st. If the house is only 50% complete, then we're only going to appraise it at 50% complete. If the house is there January 1st, but then gets torn down in July, well, it was there January 1st, so you're going to pay taxes on it as it was on January 1st for the full year. Appraisal districts are going to use the sales of similar properties in your neighborhood to determine the market value of your property. And when we look at market value and determining those sales and those characteristics that add value or that we use to determine market value, some of the key ones, some of the key components that we use are going to be the size and the type of improvements on a property. Is it a single family residential? Is it a duplex? Is it a condo? Is it a townhouse? And how large is it? Is it a small bungalow? Is it a McMansion? Those size and types of improvements all add to our equation and how we calculate the value of your property. We're also going to look at the construction materials, the quality, and the condition. Is it a house with all wood siding? Is it all brick? Is it using high-end property characteristics? Is it well maintained? Those all come into play. And then we're also going to look at some site characteristics. How large is the lot? Is there a swimming pool? And other factors that will just add to the value of the property. Information about your property and the characteristics that we are calculating on your property are available on the Appraisal District's website. And we'll talk a little bit later about our website and tell you how to get there. But just know any information that we're using in our models to appraise your property is available for you to review on our website. Exemptions. Now, an exemption can lower the taxable value of your property, resulting in a lower tax bill. So if you recall, we appraise and we determine a market value of your property. Then there's the calculation that determines your assessed value, which is last year's assessed value plus 10%, or the current market value, whichever is lower. And then your assessed value minus any exemptions becomes your taxable value. So exemptions are really a good tool that property owners can use to kind of lower their taxable liability. There are different kinds of exemptions, but the most common one we talk about are homestead exemptions. And the first of the homestead exemptions is your general residential homestead exemption. Most property owners that own and occupy their home as their principal place of residence can qualify for a general residence homestead. Now, there are some qualifications, we'll talk about those, but for the most part, most homeowners that are owning and occupying their principal place of residence can claim it as their homestead and get a homestead exemption. On top of the general homestead exemption, some property owners may be able to also qualify for other exemptions in addition to the general homestead exemption. The most common of those are the over age 65. So if you're over the age 65 or the surviving spouse of somebody who is over the age 65, or if you're a disabled person, there are additional exemptions that you can claim. And those are additional amounts that are taken off in addition to the general homestead. Now, for the over age 65 and the disabled person exemption, you can claim one or the other of those. You cannot claim both of those on one property. You can claim either the over 65 or the disabled person's exemption. Most taxing entities, those exemptions are the exact same amount. So it doesn't make a difference which one you claim, but they are available, but you can only claim one of the two. You can't claim both of those. In addition to the over age 65 and disabled persons exemption, there are a couple other exemptions that are available for people with specific conditions. There's one for 100% disabled veteran, meaning that they are qualified as 100% disabled with a service-connected disability, and that's as determined by the Department of Veterans Affairs. In those cases, property owners with 100% disabled veterans exemption are exempt from all property taxes. Another category of property owners that are exempt from all property taxes are the surviving spouses of an armed service member that was killed in action. And then also the surviving spouse of a first responder who was killed in the line of duty. Those are also exempt from all property taxes. So these are the most common homestead exemptions that we see property owners claim. And it can be significant, the amount of money that you can save for a homestead exemption. And this chart just shows you for the most common taxing entity combinations that we see in Travis County, and that's Austin ISD, the City of Austin, Travis County Healthcare, and Austin Community College, the different amounts of the exemption that they're able to grant or that they've elected to grant it. So for school districts, it's state mandated. The state mandates that school districts must grant a homestead exemption, and the amount of the exemption that they grant must be $25,000. Then the cities, counties, and other taxing entities, they have a local option, and they can adopt a local option exemption of a percentage, and it can be anywhere from 1 up to a maximum of 20%. And you'll see in this case, the City of Austin, Travis County, and the healthcare all grant the maximum 20%. Austin Community College grants a 1% exemption. Again, the governing bodies of all of these jurisdictions decide how much they want to grant in terms of local option exemptions. The other most common type of exemption we see are the age over 65 and disabled person. For school districts, again, it's state mandated. The state mandates that school districts must grant $10,000 in over 65 or disabled persons exemption. In addition, Austin ISD has a local option of an additional $15,000 that they grant on top of that. And then for the over 65 and disabled person, for the other taxing entities, it's local option, and they set the specific amount that they would grant. So in this case, City of Austin grants $113,000 in exemption. Travis County and the healthcare district grant $100,000 in exemption, and Austin Community College grants $180,000 in exemption. And if you're a new homeowner that is age 65 or older, one of the bigger benefits of the over 65 or disabled persons exemption as it relates to school district taxes, and also most recently to Austin Community College, is they have a tax ceiling. So in the year that you qualify for that exemption, your school district taxes will never go above that amount. They become frozen at that amount. They may go below that amount, but they will never go above that. And since school district taxes represent almost 54% of your total tax bill, being able to freeze that in the future is a huge benefit to property owners that are over 65 or are disabled persons. Now, to apply for your exemption, generally you're eligible for your residence homestead exemption if you own and occupy your property as of January 1st of that year. Now, there are some exceptions that allow you to grant or apply for it earlier. And there are some opportunities for you to file a late application, and we'll talk about that. But in general, most property owners are eligible for that exemption if they own and occupy the property on January 1st of the tax year. As a new homeowner, you're going to get a lot of mail, and you'll get mail with pink slips, and people will offer to file the exemption for you for a minimal charge or $50. But you don't have to pay anybody to file your homestead exemption. It is absolutely free. You file your homestead exemption with the appraisal district. We've got our applications online on our website. We will mail you an application, or you can do it through our online portal. And again, it is at no cost to you. It is absolutely free to file for your homestead exemption. So if you get any of those offers that are saying, you know, pay me money and I'll do it for you, it's easy to file for it. Throw that away. You can do it yourself and save yourself some money. Again, it's absolutely free to file for an exemption application at the appraisal district. Now, one of the exceptions that I'd mentioned about when you can apply for your exemption, and it's new for 2022. So this is a law that was just passed last year. For anybody that acquires a home after January 1st of 2022, you may be eligible to apply for your homestead exemption as soon as you acquire the property. Now, there are some conditions that have to be met in order for you to qualify to file that exemption early. The first is the property cannot have an exemption on it as of January 1st, meaning the prior owner could not have claimed that property as their homestead exemption. And this is really a benefit to you as a property owner, as a new homeowner, because if a property owner has an exemption in place, a general homestead exemption in place, and the property is sold, the new owner gets to inherit the benefit of that exemption for the remainder of the year. So you, as the new owner, get to inherit their exemption for the remainder of the year, plus you get to inherit any tax limitation that they get because of their homestead cap limitation. So you get a lower assessed value and you get the full amount of their exemption. If you claim an exemption early and there was not an exemption on it, then the exemption is prorated based on the date of your qualification. So it's really important to know whether or not the previous owner had claimed an exemption on the property. And if they had, do not be discouraged that you don't get to claim that exemption, because you get to inherit the exemption from the previous owner. And it's actually a bigger benefit for you when you can inherit that exemption, because it's not prorated. You get the full exemption amount, plus you get any benefit that they might have of an assessed value. You also cannot be claiming an exemption on another property. So if you are claiming an exemption on another property and you buy a new property, you can't claim two homestead exemptions. You can only have one. So the exemption that you have claimed as of January 1st is the one that you get. Again, that January 1st exemption has the benefit of being the full amount of the exemption. It is not prorated. And then any assessed value that you've got with that exemption goes on. General homestead exemptions cannot be ported or transferred to other properties. Only over 65 or disabled persons exemptions can be transferred. So a general homestead exemption, once it's claimed, it is on that property and it's on the property for the remainder of the year and cannot be moved to another property until the following year. And then you have to meet the other qualification requirements for the exemption. It has to be your principal place of residence, and you have to own and occupy that property. So when we talk about owning and occupying, I know a lot of new homeowners are buying houses that are being constructed or under construction. Just because you purchased the property in March does not mean that you may be able to claim the exemption in March if it's still under construction and you're not occupying it. You get to claim the exemption as soon as you occupy the house. So if you buy it in March and it's still under construction and you're not able to occupy it until August, August becomes your qualification date. And as I said early, any newly eligible homeowner who are applying for the exemption on a property that does not already have an exemption, that exemption is prorated based on the date that you qualify. So we take the number of days left in the year based on the date that you qualify, divided by the total number of days in a year, and that becomes the percentage of the exemption that you get to have for that year. To apply for your exemption, you've got to provide copies of supporting documents required for the exemption that you wish to claim. For the general homestead exemption, most people can qualify for that general homestead exemption. You are required to provide a copy of your driver's license or your Texas ID card. Again, they have to be a Texas driver's license or a Texas ID card, and you have to provide a copy of that with your application. And the address on the license must match the property address of the property you're claiming the exemption for. So as soon as you purchase a house, one of the first things that you're going to want to do is you're going to want to get your driver's license or your ID card updated. And then make sure that that address is matching. Then you can submit that application and a copy of your driver's license. That's one of the things that most property owners, new property owners, forget to do when they're submitting their application, is they forget to include a copy of their driver's license or their ID card. And again, we are required to require that Texas driver's license or Texas ID card. We cannot accept a passport. We cannot accept a concealed carry card. We cannot accept any other form of identification. It must be a Texas driver's license or a Texas identification card. If you are requiring or requesting a disabled person's exemption, then there's a letter that you get from Social Security Insurance, the SSI. There's a disability letter that you want to include with your application. If you're claiming one of the disabled veterans exemptions, the 100% disabled veteran, or the spouse of a veteran killed in action, then there's a letter that you're going to get from the Veterans Administration. There's a disability letter or a letter of a member killed in action that you're going to want to provide with your application. And then if you are the surviving spouse of a first responder, then there is a Texas Employee Retirement System letter that you would include with your application. You only need to apply for an exemption on your property once, unless there's a new deed filed on your property or the chief appraiser asks you to reapply. And we do occasionally audit our applications and ask people to reapply so that we can verify that they are still qualified. And we do that just based on some general algorithms based on time. But occasionally you will get a request for a new application. It's very rare, but occasionally that will happen. Most commonly, you will get a request for a new application or your exemption when you'll need to reapply for your exemption is if you file a new deed on your property. And some of the reasons people will file deeds on their property is they may be doing some estate planning and they may put their name in the name of a trust as the owner instead of the individual. Well, to the appraisal district, that is a change of ownership because the deed is reflecting a different name as the owner of the property. So the exemptions would be removed. You would need to file a new application. Now, if you put your property in the name of a trust and you are the beneficiary of the trust, you can still claim a homestead exemption. But you just need to submit your application and let the appraisal district know that this was not a true change of ownership, but that it was actually done for estate planning purposes and you were still the actual owner and beneficiary of the new trust. It can be done because you are updating a name if you change your name for several reasons, or maybe you're removing an owner, you get divorced or a spouse is deceased and the name's changed. A lot of homes that were bought many years ago, they were put in the name of the husband, and when the husband dies, then a new deed is filed and it's putting it in the name of the wife, but it's a different name. So to the appraisal district, it's a different owner, and we have no way of knowing that the exemption should continue unless you tell us. So those are some of the common reasons why property owners will see their exemptions being removed, and it's because new deeds were filed. And again, you just have to let the appraisal district know that the exemption should be continued, and let us know that you're doing it for estate planning, you're the beneficiary, or it's a divorce, send us a copy of your divorce decree, or your spouse died, send us a copy of the death certificate and your marriage license so that we can see that that exemption needs to continue. But generally, the first time that you file for your exemption, unless you do something that's going to reflect a change in ownership, you should not need to reapply. So you're ready to file your exemption. How can you go about it? Well, if you can go to our website, which is www.traviscad.org/homestead exemptions, and you'll see a copy of the exemption. So if you want to paper file it, you can download and print a copy, fill it out and mail it back into the appraisal district, or you can go to our online portal and submit your application online in the online portal. It's a little bit speedier if you send it, do it online. That gets processed a little bit quicker than those that get sent in by mail. We're seeing a lot of delays in mail, so mail takes a while to get in. Plus, it's a lot more paperwork that we have to manage and handle, so it takes us a little bit longer to process homestead applications that are submitted by mail. But you can do it, again, you can do it by mail, you can do it on our online portal. And if you have any questions, there's some FAQs on our homestead exemption page. But if you have any questions, you can also call our exemption hotline, and that number is 512-873-1560. So the other thing that the appraisal district does is we'll send out notices of appraised value, and those are mailed out in April. And we start generally around April 1st, but again, they will be mailed throughout the month of April. You may receive a formal notice, or you may receive a postcard. If your value goes up, market value is increased by more than $1,000, you're going to receive a formal notice. If your market value isn't changed, you'll receive a postcard. If you do not receive a mailing, or if you think it's taking too long, you can always go to our website, because as soon as we start mailing them out, we also start putting a copy on our website. So you can download a copy of the same form on our website just by going to our website. It's out there as on the website, as well as getting mailed to you physically. You'll notice on the notice of I'm going to list for you what your market value is. And then if you have any assessed value, which will include your homestead limitation, that will be listed on your notice of appraised value as well. And then we'll list for you all of your taxing entities and any exemptions and the amount of those exemptions that you may be qualified for. So your notice of appraised value is going to be another place that you can look to verify that you are getting the exemptions that you're entitled to, and you'll be able to see exactly how much that exemption for each taxing entity is worth. You can also protest your property value. So if you disagree with the market value that we put on your notice of a protest, you can file a protest with the appraisal district. There's a protest included with your notice of appraised value, and you can mail that form in, or even quicker, you can do it online and file your protest online. It's important for you to remember that you are protesting the market value, because that's all that the appraisal district does, is determine the market value. You're not protesting your property taxes. Property taxes get set based on the budgets of the taxing entities and the tax rates that are set. So if you see a taxes and you say, I can't afford my taxes and I want to protest, that's not something that you take up with the appraisal districts. That is something that you would take up with your taxing entities. But for your market value, based on what properties around you are selling for, the market value is something that you can protest at the appraisal district. The deadline to file a protest is May 15th, or 30 days after your notice is mailed. So if we mail your notice of appraised value out late in April, then your protest deadline is going to be 30 days after the notice of appraised value is mailed. And your protest deadline will be posted on your notice of appraised value. So you'll be able to see that actually on the notice of appraised value and know exactly when your protest deadline. But generally, most notices are sent out by April 15th, and the protest deadline is May 15th. Even if you successfully protest the market value, your assessed value might not change. And again, market value can go up just depending upon what is going on in the market, but the assessed value is last year's assessed value plus 10%, or the current market value, whichever is lower. So if the market value is going up substantially, even if you reduce your market value, it may not go below your assessed value. So you're not changing your assessed value. And again, you don't protest your assessed value. That's just a calculation based on last year's assessed value. What you protest when you protest to the appraisal district is you're protesting the market value that we appraised your property at for the current year. If you protest, you can settle your protest after an informal meeting with an appraiser at the appraisal district. Or if you don't come to an agreement with an appraiser at your informal, you're entitled to present your protest to the Appraisal Review Board. Now, the Appraisal Review Board is an independent body. They are appointed by the local administrative judge. They are not TCAT employees, and we do not have any influence or authority over the ARB members and the decisions that they make. Again, they are appointed by the local administrative judge, and their purpose is to hear the evidence presented by both the taxpayer and the appraisal district and make a determination of what the market value should be. So again, you've got an opportunity to resolve it informally in meeting with an appraiser, Or if you don't resolve it only with your meeting with your appraiser, you can go to the appraisal review board and have a formal hearing with the appraisal review board. I mentioned earlier our website, and again, it's really important for you to go out and learn our website. There's a lot of valuable information on the website that you can get. It's www.traviscad.org. You can do a property search on our website. So you can look up your individual property and you can see the characteristics that we're using on your property. You can get a copy of your notice of appraised value. If you're wanting to protest, you can look up and see what we've appraised properties near you at. So you can look up any property in our property search. You can also get forms and applications. So your exemption forms and applications are on our website as well. Plus, we have portals online for property owners. So you can file your applications online. You can file your protests online. There's a lot of resources that are available on our website. We also do the property owner webinars. This webinar is being recorded and it will be posted on our website. So if you want to go back and watch it again, or if you want to tell a friend about it, and they can go to the website and look at our webinars and they can watch a replay of this webinar. We also have frequently asked questions. So some of the common questions that they have, those answers are all posted on our website. And then we also have a customer service chat. So if you have a question and you don't see the answer on our website, you can also get on a quick chat with one of our customer service representatives and they can attempt to help you over the chat. So again, our website is a great resource for property owners, and that's www.traviscad.org. One of the final players is the role of the taxing units in the whole property tax equation. And changes in your property value may affect your tax bill, but they don't necessarily increase or decrease the total amount of taxes that you paid, because that's really determined by your taxing unit's budgets and the tax rates that they set. So if your taxing unit has a large budget, then how much you pay in taxes is going to be a lot larger than it would be if they had a very small budget. So your taxing units and the budgets that they set are a real key part of how much you're paying in your taxes. The role of the appraisal district, again, is to make sure everybody's paying their fair share. We're slicing the pie, but how big that pie is based on the taxing unit budgets. The appraisal districts are just slicing it and giving everybody a proportional share based on the market value of their property. So you can see in the two pies, one pie is really big and you'll pay a lot larger, and you're getting your slice of pie. Again, the appraisal district determines the size of the slice, but the overall size of that pie is determined by your taxing entities and the budgets they set. There is a website that you can go to, travistaxes.com, that kind of helps you see a breakdown related to your property. You can go to that website, you can look up your specific property, and you can see for each taxing entity that charges taxes to your property, what their budget is, what their tax rate is, how much you would need to pay based on the tax rate. It'll show what their no new revenue rate is, what their proposed rate is, and what's the difference, so that you as a property owner can weigh in on that. It'll also give you information about when they're doing their budget hearings and their tax rate setting hearings, so that you can weigh in. Again, as property owners, the taxing entities are trying to provide us services, but they need feedback from us as citizens about what is important and then what we think we can do without, so that we can lower those budgets. And that is all information that you can get on the travistaxes.com website. Now, I mentioned a no new revenue rate, and that's one of the rates that the taxing entities have to set. In fact, that's the first thing that they do after the chief appraiser certifies the values to the taxing entities, and I do that on July 25th. One of the first things that they have to do is they have to calculate a no new revenue rate. And that's the tax rate that they need to generate the same amount of revenue that they had received in the previous year. So if appraised values go up, that no new revenue rate will go down because you want to generate the exact same amount of revenue. Or if appraised values go down, that no new revenue rate might go up. So again, it's kind of like a reset button on the tax rate. That no new revenue rate is the starting point each year based on the certified values. And again, it's the starting point to get them the same amount of money in the current year that they received in the previous year. The next rate that's really important for you guys to know is a voter approval rate, because in addition to having a homestead and a limitation based on a homestead exemption, there are some limitations placed on the revenue side or the rate side of taxing entities. So there are some limits, and the voter approval rate sets those limits. And if a taxing unit wants to go above a voter approval rate, they've got to get taxpayer approval at the November election. So for cities and counties, they can increase their tax rate and get 3.5% additional for operating expenses above the no new revenue rate. So they can go up 3.5% on their tax rate. Junior colleges, hospitals, and special districts, which are MUDs and ESDs, they can go up 8%. And then school districts, that's based on their debt rate and how much state funding is contributed. Those all influence what their voter approval rates are. But the travistaxes.web.com website will show you what the voter approval rates are. And again, if they're going to adopt a rate above the no new taxes, then they're adopting a rate that's going to increase your taxes. But there's a limit to how much they can go above the no new taxes, and that's the voter approval rate. If they want to go above a voter approval rate, that is something that happens in the November election. It's the same as a presidential election and the general elections in November, the first Tuesday in November. That election is where you can vote to either approve or disapprove of a tax rate above a voter approval. So you have some control as a taxpayer on both the budgets and also the tax rates that get adopted by your taxing entity. But you've got to make sure that you're participating in the process. And by participating, you've got to engage in the budget hearings, engage in those tax rate hearings, but also make sure that you're registered to vote so that you can go out and vote in those November elections. Every vote counts and your vote will matter. After the tax rates are set and everything is calculated, your tax bill will be mailed out to you by the Travis County Tax Office. And again, exemptions take value off your assessed value. They don't take money off of your taxes, your tax bill. That's done at the taxable value side. But that taxable value is used to calculate your taxes. So taxable value times the tax rate equals the amount of taxes that you pay to each taxing jurisdiction. Your tax bill can go up more than the 10%. Again, a lot of people confuse the 10% homestead limitation and thinking there's a 10% limit. And as we talked about before, there are new limits in terms of tax rates that are being established. So your tax rate can go up more than 10% if you as voters vote to approve bonds or vote to adopt a new tax rate above the voter approval rate. The over 65 exemption, we talked about that freezing your taxes. It's important to remember that only freezes your school district taxes, and newly started for last year, it freezes the amount of taxes that you pay to Austin Community College. So if you are over 65, your taxes are frozen only for the school district and the community college, but they may go up for the other taxing entities, the city, the county, any ESD or MUD that you may have to pay taxes to. One of the things that we find are some situations that surprise new homeowners. And this is an example of the most common thing that we see that surprises new homeowners. So in this situation, Jack and Jill have owned their home for 30 years. Jack is a disabled veteran, and both Jack and Jill are over age 65. Jack and Jill pay $2,000 a year in property taxes because they've got veterans exemption and they got an over 65 exemption. In 2020, Jack and Jill sell their home to John and Jane. So John and Jane are the new homeowners. They're young, they're first-time homeowners, and in the year that they bought the home, they pay $1,500 of the property tax bill for the house they just bought. That's done, usually you'll see that being done in escrow, and they'll calculate how much of the tax bill that you would need to pay. Then in 2021, they are shocked to learn that their property tax bill will be $8,000. Now, they were basing their expectations based on the tax bill that they inherited from Jack and Jill. But what happens is Jack and Jill had that over 65 exemption. They had that tax ceiling on their school taxes. And when they sell the property the next year, those go away. And John and Jane are now establishing themselves, but they're not over age 65. They don't have the tax ceiling. They don't have those huge over 65 exemptions. So their tax bills are going to go up significantly. So new homeowners, again, are often surprised when they get their first full year tax bill. And that's because a lot of times the title companies, they're not researching the history behind the home's property tax bill. They're not recognizing that this is somebody that's over 65 and you're inheriting a great benefit this year, but next year it's going to change substantially. So we recommend to property owners, do your own research. Estimate your property taxes based on the purchase price of your home and not what the previous owner paid. Because again, when you buy the home, you're going to establish your own exemptions, and you may not be entitled to the same kind of exemptions that the previous owner had. Another situation that often surprises new homeowners, particularly when they're buying homes that are brand new or brand new construction, is that on January 1st, the house might have been vacant land. And so you're only paying on the land, but the following year, when the house is complete, you've got to pay for both the land and the house. And so they'll also see their taxable value go up substantially, and consequently their tax bills go up substantially, because you're not just paying on only land, you're paying on land and a house now because it's a brand new home on the property. So those are two things that really surprise new homeowners, and we want to make sure that you're aware of that so that you're not caught off guard. Some common misconceptions, again, that your property taxes can increase only 10% a year. That 10% limitation is only the appraised value limitation. Your property tax bill may increase more than the 10% year, depending upon the budget set by your taxing entity and any bonds or tax rates that are approved by you as voters. So there's not a hard 10% limit. That limit is only to the assessed value if you have an exemption, but your tax bill, again, has more parts, more things that play into that role. And again, a big part of that are the budgets set by your taxing units, the bonds, and the voter approval rates that you approve as a voter. Another common misconception is because Texas is a non-disclosure state, it's illegal for the appraisal district to know how much a property is sold for. And that's false. Being a non-disclosure state just means that the appraisal district is not given this information automatically after the transaction occurs. It does not mean that the appraisal district cannot know this information. And again, we're expected to know this information because our requirement is to appraise properties as of January 1st at 100% of market value. So the expectation is that we'll know this. Non-disclosure just means that it's not given to us automatically. Another common misconception is that appraisal districts raise property values to raise money for taxing entities. And again, that is not accurate. By law, we must appraise properties at market value as of January 1st of each year. And a lot of people are not aware of this, but we get tested every year by the state to make sure that we're doing our jobs correctly. They test us to make sure that we're following appropriate methods and procedures. And then they test the level of our values to make sure that we are appraising properties at 100% of market value. So we're required to appraise properties at 100% of market value because that's what's required by law and by constitution, but we're not doing it just to raise money for the taxing entities. That's how our laws are requiring us to do our jobs. Another misconception that appraisal districts raise property values and the taxing units, if appraisal districts raise property values and the taxing unit kept the rate the same, so the appraisal district is really the one that raised my values. And we see that a lot. Oftentimes people say, well, the tax rate is the same as it was last year. So it's not because we raised tax rates that your taxes have gone up. But you've got to remember that no new revenue rate. Remember we talked about that no new revenue rate and the fact that it's a reset. If appraised values go up, that no new revenue rate goes down. That becomes your new starting point. That's a reset. That no new revenue rate is what you should compare to, not last year's rate. So if a taxing entity adopts a rate above the no new revenue rate, they're adopting a rate that's going to increase your taxes. And it's not because of the appraised value increasing. Again, as appraised values go up, that no new revenue rate goes down, and it's a reset. We are, in terms of appraisals, intended to be revenue neutral and not increase your taxes. Those decisions are in the hands of the governing body of your taxing entities and the tax rates that they adopt, and then ultimately the tax rates that you approve as a voter if it has to go to a voter approval election. One of the things that you can do to get involved, and we talked about the November election, and those are really important, but there's another election coming up this year on May 7th. Texas voters will have the opportunity to vote on reducing their property taxes. There's going to be 2 propositions on this election. The first is to provide some tax relief to property owners who are over age 65 or disabled. In prior years, back in 2019, there was some reformulation of the school funding and school tax rates went down. But because people that were over 65 or disabled had their taxes frozen, they never saw the benefit of those new rates and those changes. So the first proposition would be to give property owners that are over 65 or disabled an ability to get their tax ceilings adjusted down to reflect those changes in the state funding given to school districts. So that's proposition 1. Proposition 2 is to increase the school district homestead from $25,000 to $40,000. So that's a pretty substantial increase in the state mandated exemption for school districts. Now, again, this is only changing the school district's state mandated exemption, but it would change it from 25 to 40,000. And I heard some ads on the TV, and I forget whose ad it was, but there was one that was saying it was increasing it from 15 to 40, and that's not correct. The proposed change would be to increase it from 25,000 up to 40,000. You can go to votetravis.com and you can do voter registration. You can get information about your polling places. Again, a lot of information about the May 7th election would be on the votetravis.com website. So if you're unsure of where you would go, if you're not sure if you're registered to vote, we encourage you to go there. But we also encourage you to go and participate on May 7th. If you would like to see your homestead exemption increased, it's important for you to go out and participate and vote for that increase in the exemption. Our next webinar that we will do will be a webinar more specifically on more detailed information about homestead exemptions. And we'll do that on Wednesday, March 23rd at 11:30. And with that, I'm going to start looking at some of the Q&A questions and see if we can answer some of the questions for property owners. So we filed a homestead exemption in November of last year, but the TCAD record of our property has not shown the homestead status. How do we know if it's approved for homestead exemption, and will we get notified? Okay. So yes, we are processing exemptions. It takes us a while. It may take us up to 90 days or longer. We're like a lot of other governmental organizations and a lot of businesses in general. We are suffering from staffing shortages, and we've got a lot of intermittent outages because of COVID. So we are behind a little bit in some of our processes, but we are catching up. We're spending a lot of time in overtime to get caught up on that. I would say check our website, check it frequently, but more important than that, look for your notice of appraised value in April, because any exemptions that have been granted to you will be reflected on that notice of appraised value that you get in April. And if you've got a homestead exemption and maybe you forgot to apply for your homestead exemption, you can apply for a late homestead exemption. You can go back up to 2 years late and apply for a homestead exemption. So it's never too late to apply for your homestead exemption. And if you apply for a late homestead exemption and it's granted, you'll get a refund of any taxes that you may have paid. So again, check our website, but more importantly, look for your notice of appraised value, and that notice of appraised value will list for you all of the exemptions that you're entitled to, and you'll see that coming in April, and we'll mail you a copy of that notice of appraised value, but we'll also post those up on our website. Now, again, they get sent out and mailed out in rolling batches, so they don't all go out in the first batch, but check each week to see if your batch has gone out. How do we notify TCAD about a deed change to a trust for estate planning purposes? Should we just send a letter to TCAD? Yes, you can send a letter to TCAD, but you can also get online and do a chat with our staff and let them know, and they'll give you an email address that you can send that information to. But yes, before you do your estate planning, if you give us a heads up and we know to look out for that, we can flag your property and we can start trying to track that. Now, just because you let us know doesn't mean that we will always see it, because we've got tremendous volume of work and we may occasionally miss something. If we miss it, please reach out to us again and let us know, and we will take care of that for you. A homestead question: if we build a deck or a shed to our home, is the assessed value still capped at 10%? or reset to the full market value, or do we just have an adjustment? Okay, that's an excellent question. So when we talk about your assessed value, we're talking about it in general terms. Your assessed value is last year's assessed value plus 10%, or the current market value, whichever is lower. However, there is an exception that if you do something to improve your property, if you are adding a swimming pool, or you add an extra bathroom, if you're adding more to your property, then the value of what you've added, just the value of what you've added, gets added to your homestead cap. So it would be last year's assessed value plus 10% plus any new value. If you add a pool that's worth $10,000, then it would be $10,000 for that new pool, and that becomes your new assessed value. So when you add things to your home, it doesn't reset your assessed value to the full market value, but it may adjust your assessed value to something a little bit more than just that 10% plus, because it's any new value that you've added to your home plus the 10% from the previous year. The next question is, I heard there's a 10% cap on the appraised value for homeowners. We bought our house last November and filed for the homestead exemption. Are we qualified for the 10% cap for 2022? Okay. So the way that the homestead cap works is that the first January 1st that you qualify for your homestead exemption becomes the base year for your cap. So that becomes your starting value. So if you applied for your exemption in November of last year and you're qualified for it for January 1st of 2022, your 2022 value becomes your base value. Then every subsequent year, they're going to look at your assessed value plus 10%. So your base value, which will be your market value in 2022, plus 10% will become your assessed value in 2023. That is an excellent question. Yes, your homestead cap, again, the first January 1st, that you qualify for the exemption establishes your base value, and then in subsequent years that 10% cap kicks in. The next question is, who set the 10% limit on increases, and why does it always go up by that limit? That limit was set by the legislature, and they said that there was a 10% limit. So if you want to see any changes on that limit, you would need to talk to your local representative or your local senator about legislation to change that. Again, that is legislation that was set by law, and there's nobody can change that unless it's done by the legislature. The other half of the question is, why does it always go up by that amount? If there is a substantial increase in the Austin market, and you know, last I heard reports was the Austin market has gone up 30% over the previous year. Well, if the market value goes up 30% and the assessed value is last year's assessed value plus 10%, or the current market value, whichever is lower, you've got 3 10% steps just to catch up to the market value. And that's why you see it going up every year by the 10%, is because the Austin market is just going up so much every year that you're always trying to catch up to the market value. Again, the assessed value is last year's assessed value plus 10%, or the current market value, whichever is lower. But our Austin market, again, we've got so little inventory and so much demand, and those housing prices are selling for so much that the market is escalating so much that there's a huge gap between market value and assessed values. Are there any limits on the increase of tax rate, or does that often get confused with the assessed limit? Good question. Yes, the limitation for your assessed value often gets confused with limitations on the tax rates. And I will say this, the limitations on the tax rates are fairly new. In the past, the limitation used to be 8%. All taxing entities would be able to go up on the tax rate 8%. But in 2019, the legislature changed that and instituted some additional limits. So the new limits for the taxing entities varies depending upon the taxing entity that you're in. But for your city and counties, which are both big chunks of your taxes, they typically range between 18 and 20% each of your total tax bill. Those now can only go up 3.5% unless they go for voter approval in November and voters approve a rate higher than that. So there is now a limitation on tax rates. There's a limitation on school taxes. The school tax rate limitation is a little bit more complicated because it deals with a lot of state funding. A general rule of thumb is about 2.5%. It could go up 2.5% unless they go for voter approval vote in November. So there are two different limits now that we see in the property tax equation. There are now limits on the appraised or assessed value of properties, but there are now limitations on the tax rates and the growth of the tax rates. But again, voters can approve to go above those limits. Next question is, I own property on January 28th of 2022. Will the exemption from my previous owner be transferred to me? So yes, automatically, if it is a general homestead exemption, you get to inherit the general homestead exemption and any assessed value limitation from the previous owner. You inherit that for the remainder of the year. And then come January 1st of 2023, you will qualify for the exemption in your own right. You'll get your new exemption amount based on the exemptions you qualify for, and your base year will start for you. Now, something important for homeowners to recognize is an over 65. And I'd mentioned earlier that over 65 exemptions and disabled persons exemptions can be transferred. So if you are buying a home and there is an over 65 exemption or disabled person exemption in place, talk to the owner and the title company at closing and make sure that that owner is not intending to transfer that exemption, because that owner can at any time during the year transfer that exemption to a different property. And that means we've got to take it off of their original property and put it on their new property. So if you have a property that you are buying and they have a general homestead exemption, you can inherit that for the remainder of the year. If there is also an over 65 or a disabled persons exemption in place on that property, you need to check with your companies at closing and make sure that those exemptions will not be transferred. Otherwise, your tax liability may change, and it may change substantially if that owner decides to transfer those exemptions. So again, another word of caution to property owners that are new first-time homeowners: when you're purchasing your property and it's got exemptions in place, you inherit the general homestead. But if it's an over 65 or disabled persons, you may not inherit that if the property owner decides that they want to transfer. The next question is, if my father and I jointly own a home 50-50, but I'm paying the taxes, who gets to claim the homestead exemption and by what percentage? Okay. So if you are claiming, you own the property 50-50 with your father, if he is claiming a homestead exemption on a different house that he owns and lives in, he cannot claim an exemption on your property, which means that you get to claim a homestead exemption on the portion of the property that you own. So if you own 50% of the property, you can claim an exemption on the 50% that you own. So you would get 50% of the exemption. So again, you can claim a property if you only own a percentage of it, but you only get the exemption on the percentage that you own. And again, you cannot claim an exemption on more than one property. So you can't have a vacation home and a house that you live in and claim an exemption on both of those. You can only claim an exemption on one. I closed my home in 2021. Am I qualified for the exemption in 2021? And how about 2022? Okay. So if you closed on your house in 2021, you are qualified for the exemption for year 2022. You are not qualified for 2021. The new law only applies to homes acquired after January 1st of 2022. So since you acquired your home before that date, you cannot claim that early exemption date. You do qualify for 2022. So you can file your exemption now and claim it for 2022, and you would get the exemption for 2022. One more question. We bought our house last year. Should we expect a huge increase on the tax bill for 2022 since we don't get the 10% cap until 2023? So we advise property owners, if you just bought your house and you're wondering or trying to estimate what your property value and your taxes are going to be, use the price that you purchased your home for. Again, our requirement as an appraisal district is to appraise properties as of January 1st based on the market value, 100% of the market value. What would it sell for? And one of the best indicators of the market value of your home is what you paid for it. So if you're trying to estimate what your escrow needs to be, how much you're going to have to save for taxes, use the amount that you paid for your property. Again, we'll send our notices of appraised value out in April, but for you, for estimating purposes, don't use the prior owner's estimate of taxes and don't use their value. Look at what you actually paid for your property, use that as your estimate moving forward. That's going to give you the best estimate of taxes. And one final question, is the over 65 exemption only for a property owner, or also if you have a disabled or over 65 person who resides there? You have to own and occupy the property, so it is only for the owner. So if you are somebody that has your elderly parent living with you, your parent, if they are not an owner of the property, cannot claim the exemption on the property. Only the owner of the property who owns and occupies the property can claim that exemption. And we just had one last one pop up, and that's it. That was the last one. So we are out of time. I'm just a little bit over, but I really want to thank you guys for joining us today and for all of your time and attention. And again, our next webinar will be on more information about homestead exemptions, and that will be Wednesday, March 23rd at 11:30, and we hope to see you there. Thank you guys very much. Bye-bye.